the easy guide to adjusting entries for revenue. There are two bases of accounting. That is, the cash basis, which records revenue when cash is received and expenses when they are paid in cash, as well as the accrual basis, which is required under the generally accepted accounting principles, which records revenue when earned and expenses when they are incurred. This means that cash is never used when adjusting entries. There are four different types of adjusting entries. They are deferred revenue, accrued revenue, deferred expenses, and accrued expenses. For the purpose of this video, we'll only be focusing on revenue. Yes, I do know what you're thinking. Deferred revenue. Deferred revenue refers to revenue which has not yet been earned, but represents products or services which are owed to a customer. Let's give a real-life example. Josh runs a ski supply store. On November 1st, Josh receives $20,000 cash for an order of 50 snowboards. This is how it looks in a general journal. We debit cash as an asset for $20,000 and we credit unearned revenue as a liability for $20,000 as we now owe 50 snowboards to our customer. This is the original transaction. Josh prepares financial statements on the 30th of June. 23 snowboard orders have been fulfilled. This is how it looks on the general journal on the 30th of June. We debit unearned revenue for $9,200 as we are decreasing the liability, and we credit revenue for $9,200 as we now have earned the revenue. We get this number by dividing 20,000 by 50, which gives us $400, the price of each snowboard. We then times this number by 23, which gives us the grand total of $9,200. This is the adjusted entry. Accrued revenue. Accrued revenue refers to revenue which has been recognized by the seller but has not yet been billed to the customer. We'll look at an example. On May the 1st, Josh provided $6,000 worth of equipment to a customer. As of the 30th of June, this amount has not yet been collected. It was agreed that the customer will pay it back on the 15th of December. This is how that looks on the general journal. We debit accounts receivable as an asset of $6,000 as we will receive that later on, and we credit sales revenue of $6,000 as we have earned the revenue. The adjusted entry is made before any cash is received. Remember, with deferred revenue, the adjusted entry is after cash is received, and with accrued revenue, the adjusted entry is before cash is received. Thank you and good luck.